All right, welcome to the future of real estate finance. You have an excellent panel here that is going to do their own introductions, but Mark Myers, the head of Wells Fargo Commercial Real Estate, is going to be the moderator, and I think it's going to be great. Up to you, Mark.
Well, great. Well, thank you all. So we have about an hour together. I've got four esteemed panelists who, each in their own right, play a significant role in the real estate finance space. So it'll be interesting to hear their perspectives. I've teed up a number of questions for them that cover both the industry, the competitive landscape, the future real estate, and then I'm going to ask them some personal questions about how they run their businesses. So we've sort of mixed it up. I think we have an hour. Do we have a clock somewhere, or am I just going to look at my? Okay. So we'll probably go for about 45 minutes as a group, and then we should open it up to Q&A. Does that work?
Did we plant any questions in the audience?
I have a few colleagues here who I'm sure will ask some questions, right,
Excellent.
Emily? Yeah. So
all right, we got one.
So they've got 45 minutes to give it some thought. So again, that's the format. I'm going to dispense with formal introductions, although I will each ask them to talk a little bit about their business. So sort of with that, if we set the stage for the business, it's about a $3.5 trillion market, the mortgage market. Today about 50% of all mortgages are held in the regulated commercial bank market. So that would be Tom and myself can obviously focus there. And then from when you go beyond that 50%, you break down the other 50%. It's pretty evenly distributed between the CMBS market, the life insurance company market, the GSE market, and the otherwise known as the non-regulated lenders, both public and private. Unfortunately, we have a couple of colleagues that are going to speak. Greta and Jonathan can speak about that market. So $3.5 trillion market, pretty efficient. By the way, swim lanes now are confused because everybody plays in everybody else's lane. Delinquencies are at an all-time low in the debt space. Less than 1%, about 70 basis points of delinquency. To put that in perspective, at the height of the great financial crisis, delinquencies were about 9%. So we're operating at extreme low levels of delinquency. Market's very fluid. So with that, let's dive into it. So Tom, since you're sitting on my left,
I knew I should have said that.
Yeah, you shouldn't have. You shouldn't have. Let's get started. We made it through another year, Tom. Another year, remarkably, in this environment where it feels like the cycle is long in the tooth and haunting us, that maybe it's ending very quickly. Yet we made it through another year. So, Tom, how do we make it through 2020?
You mean putting aside the political aspects and importance of 2020, but just as part of a real estate cycle?
Yes, as part of a real estate cycle. Thank you.
Well, I mean, we're in the longest cycle from a macro standpoint and hence from a real estate standpoint that we've ever seen. And you always get the question, are we in the ninth inning, the eighth inning? But there's no law that requires a baseball game to end at 9 innings. I mean, a bunch of them do go on longer and longer, okay, to the point where you just want to leave, right? So the question is, do we see something on the horizon that could precipitate a downturn, right? But I think that's a much larger issue, not just related to real estate. I think it's a macroeconomic issue because if the macroeconomy turns down, real estate will get impacted, right? Because it is a responder industry at the end of the day to demand, to consumer demand, corporate demand, industrial demand. And so the real thing to focus on is, are we going to see a turn in the macroeconomy? And that's, we're going to hear all about that during the campaign debates in the coming months. But given the fact that we still have ultra low interest rates given the fact that we just saw, for instance, what happened, the dislocation in the repo markets, which really made people nervous, given the geopolitical things, given the consumer sentiment that's beginning to turn down. Any one or a number of those things could be the precipitation. I don't think it's going to be the real estate industry, though.
I'd agree with that. So appreciate that macro perspective. Greta, and by the way, I think everybody's familiar with Citicorp, but Greta, maybe you could just spend a minute on TPG Real Estate Finance.
Sure.
Tell the audience about your business, and then I've got more of a micro question for you.
Okay, sure. So I'm with TPG Real Estate Finance Trust, and we are a public commercial mortgage REIT, and which was sponsored by TPG, the global investment asset manager with over $100 billion in assets, very small compared to Blackstone. But we are, our current sole strategy is through this mortgage REIT. We intend to expand our strategies over the years, but we are a lender on transitional assets. All our loans are LIBOR-based. We are a first mortgage lender predominantly. At this point in time, we have no mezzanine loans. We could do them, but they would be moderate leverage. And we lend in the major markets in the U.S. From construction loans to any asset undergoing some element of transition.
So great, thank you. So question for you, have you seen any deals in the last 6 months that would suggest the end is near?
Yes, borrowers always try to show you ones that might suggest the end is near, but frankly, I think there is very significant discipline in the market. We are seeing some loosening by maybe some of the private debt funds, but I think the commercial banks, the insurance companies, and the public mortgage REITs, because we're regular reporters, I mean, that's not the reason to have discipline, but you can see the discipline because there is transparency. I think those three lending groups are very, have maintained very strong discipline. Some of the private debt funds, maybe on the edges, we've seen them do things that we wouldn't think is completely prudent, but there's certainly no epidemic of lack of discipline. I think it's isolated cases.
So Jonathan, talk a little bit about Blackstone, not that needs a big introduction, but if you could spend a minute on your business would be helpful.
Sure, happy to. So like Greta, we raise money from institutional investors to do real estate debt. We do have a broader set of products. We have a mortgage REIT that competes in the same zones as TPG's. We also have a drawdown fund that does mainly mezzanine and construction debt. And then we have a big securities business. We own about $13 billion of CMBS and real estate corporates. And so we have a lot of different arms and legs in the real estate finance markets, and we sit within Blackstone's broader real estate business as well. So we get all the benefits of all the information and just the great resources of all my partners in the real estate business.
So Jonathan, help us and help the audience with where do you see value today in the debt space?
So, for us, value comes and goes across all these different things. And the challenge can be, because real estate loans happen in a private setting, they tend to just grind tighter and tighter and tighter every year. It's kind of how it feels. Every once in a while you'll hit a pocket, but very few assets get bought or sold during a pocket of illiquidity or refinance because everyone wants to hang on until things normalize. So the place where we tend to find the most value from time to time, that's outside of the regular way lending markets is in the securities market because things do reprice there daily. And so when you hit periods of time like the fourth quarter of last year or most of 2016, you can pick things up, whether it's corporate debt that's issued by real estate companies or CMBS, where you just see a pricing paradigm that's completely different from what you're seeing in the lending world. So for us, that's been our edge. Otherwise, we're competing with the rest of the market in the loan space, and spreads are spreads, and we have to play the game the same as everybody else.
Great, great. I'll come back to that in a thought a little bit later. But Tiffany, talk a little bit about what you're doing at Goldman Sachs. Is it the balance sheet you're leveraging? Is it third-party capital?
Yeah, so we're mainly leveraging the balance sheet. My team is responsible for large loans across ground-up construction, non-recourse, balance sheet lending, bridge lending, SASB CMBS, conduit CMBS, and then there's another part of my team that does CLO issuance, warehouse lending, and then we also do underwriting for the Fannie and Freddie K deals. So it's a pretty broad program. I would say in general, our balance sheet tends to compete a little bit more with debt funds. We've targeted higher risk, higher reward balance sheet loans. So doing more in the ground up non-recourse construction space, doing more in the very low cash flow. So going in debt yield of 0 to 1 or 2%, and then a long-term lease up play.
By the way, I heard ground up non-recourse construction lending, so that's a novel product, not many have. So Tiffany, how have you exerted discipline, which has been a defining moment? I think the lending community has been rather disciplined throughout this post-great financial crisis. How have you all exerted internal discipline? What governors do you leverage?
So I think about that in two parts. Part of it's the CMBS business and part of it's the balance sheet business. So on the balance sheet side of the business, our biggest focus is working on core assets in core markets to institutional sponsors. So maybe it's a riskier, like higher leverage point or slightly longer lease up plan where you need to take a big leasing bet in a certain market, but we feel like we have a very well capitalized sponsor to do it. So a lot of times we're focused on a market that we really like and a sponsor we really like, but maybe do a slightly riskier loan to get to the right cost of capital, but aren't sort of sacrificing. To us, it's the credit of the deal matters the most. And ultimately, you can solve, if you want to get a little bit higher risk reward, you can solve that with, let's say, leverage or something like that, or not having recourse on your construction loan. On the CMBS side, we've always thought about our own business as being very well disciplined, but if you speak about the broader market, there are all different types of studies that look at pre and post risk retention that went into effect basically 2 years ago. And almost every study is saying across the board, LTV, debt yields, et cetera, have improved post-risk retention. So I think having someone that has to own the riskiest layer of a conduit loan for 10 plus years makes them focus a lot on making sure they think all of those assets are going to survive the cycle and make everyone a little bit more disciplined.
So Jonathan,
Yeah.
similar question around discipline, and I'd be curious how you all are exerting discipline in your business. But the amount of capital that's been raised,
Yeah.
certainly in the private equity space, that is unspent, and the money that's been raised in the unregulated debt world is unprecedented. So why does that not lead to?
So I think we're
a catastrophe of sorts, right?
Catastrophe. So I think, well, I'll come to this. I'll start with the first part of the question, then I'll get to the catastrophe part of the question. The why part, I think, is a number of things. I think Tiffany focused on a few of them. I think the other thing is, on the equity side, a lot of these private equity funds that have been raised experienced the same things through the credit cycle last time that we all experienced as lenders, and have raised that money with the same discipline in mind, that they don't want to overborrow. In some cases, it's codified in their documents that they can't borrow more than 70, 75%. So we just don't see a lot of requests coming through our pipeline for irresponsible amounts of leverage. Not that they'd be met with a lot of demand, I think, from the lending community. And then I think on the lender side of things, where you do see the competitive dynamic heat up, is it could be around pricing, it could be around certain elements of the document, giving up on some covenants or extension tests and things like that. For our part, what we do to respond to that, we try to stay where we have a little bit of a competitive advantage. I was being a little glib when I said spreads move and you just have to move with it. We all, I think, have our views on the world and where we can compete a little bit better than others. One obvious advantage we have is scale. So just being a little bit bigger, there's less competition for some of the bigger stuff. Actually, usually it's Goldman or JP Morgan, not necessarily our peers in the private capital space. We also cover a lot of parts of the world, so we do see opportunities in Europe that maybe have a little bit less competition, and we can control pricing and documentation a little bit better. And the last thing I'd say, for us, what works well is, given that basis comes first, as you were saying, and if we can get comfortable with the basis in the real estate, which we can do probably as easily as anybody, given how much we own, And that's really what a lot of the discussion is when we go to committee with John Gray and Ken Kaplan and others. It's, what's our basis in this versus where we would buy things in the same market. Then we can convert that into a really good conversation with the borrower where, we can provide, I think, a differentiated client service of just saying, look, we get the asset, we get what you're trying to do, let's craft a document that helps you get through the plan. So these are the ways that we can respond to, this tightening market, this competitive market, to try to catch an edge and win a little bit more business. As far as the catastrophe thing, I know you want to talk about the GFC a little bit later, but I think one of the main lessons learned in that time, well, there are a couple things. One that will never happen again is this like leverage on leverage thing that happened, the CDO squares and things like that encouraged this pro-cyclical relevering of every asset. But the second is, I think, if you look at why Blackstone has been successful relative to some of its competitors that struggled during the financial crisis, it was because deals like Hilton were financed for a really long period of time and didn't have the covenants that allowed them to fall, that caused them to fall over. And most people who borrow money today are very conscientious of that. And so you see that, and the people who lend money are also very conscientious of that and are trying to create deals that will survive through periods of volatility.
Although Hilton did have to get restructured.
Right.
It did, no
Right.
doubt.
Right.
No doubt. Wound up being the most profitable private equity deal
Yeah.
ever. But yeah.
The one thing I would add to that, just since that's more balance sheet, and then there's the whole CMBS
Right.
side of the business, I would say things that happened in the first cycle that aren't happening now, people really aren't doing pro forma underwriting. So not only is the lender not doing pro forma underwriting, you're really underwriting in-place cash flow. The agencies are also only underwriting to the in-place cash flow. So what you ended up with in the first cycle was you had transitional loans that were structured as 10-year fixed rate loans. So then you ended up with this transition that if it didn't end up getting leased up, the loan ultimately defaulted. So there's also a difference even in the stabilized, credit classes.
Mm-hmm. I want to come back to the stabilized versus non-stabilized asset finance world, and I'll ask Greta to comment on that. But before we get there, Tom, you've got a unique perspective in terms of the public-private markets. I know you are active in the REIT space.
Right.
Sort of give us a window into that world, and is there a disconnect between value in the public space, so how REITs get valued, versus how assets are valued in the private market? And is there any telltale sign?
Yeah, I mean, sometimes they actually dovetail, but increasingly they don't dovetail. Historically, you would find that public REIT values and private real estate values were pretty much on top of one another. That was at a point in time when most public REIT investors were sort of core Cohen and Steers, real estate dedicated investors. But over the last few years, the REIT market has attracted what we call tourists, which are the hedge funds, other non-dedicated, and they're not even thinking about NAV. They're thinking about dividend growth, right? Stock appreciation, unrelated to the net asset value disciplines that the core guys did. So you see this sort of, decoupling over time. And you look at the market today, and even the best regional mall owners, still sell at dramatic discounts to what their true net asset values are, meaning what could you truly get for that $850 square foot mall. They're disconnected, multifamilies are disconnected, the lodging REITs are disconnected for sure with private markets. Mm-hmm. And but it's not unusual, and I don't think it's necessarily worrying. But people are always saying, well, which is going to be more predictive? Are net asset values going to go down over time because public values are down, or are public values going to go up over time because they're below net asset? And I don't think anybody knows.
In a investment grade REIT today, Tom, borrows unsecured at pricing range
Low
of
hundreds.
Low 100s. Low 100s. Yeah, remarkable.
That's pretty good.
Yeah, remarkable.
That's
like
not a
that.
lot of interest.
Yeah, remarkable.
No, but nobody's getting paid in any sector these days for risk, it doesn't seem.
No.
Yeah. So Greta, let's Tiffany mentioned transitional assets. So if I am here in the audience and I have a transitional asset that needs financing, and I come knock on your door, what should I be prepared for? So what do you like to see in terms of a financing package? And is there an asset class that is persona non grata at TPG today?
Sure. Well, the most important thing is alignment of interest between the lender and borrower. And I think if you have real skin in the game, that's really important. And to keep that skin in the game until the property is showing some positive cash flow. That's something that Adam Newman could have learned. But and that's really a fascinating case. I mean, I think that what happened in real estate, and Tiffany alluded to this, pre-financial crisis, was you did see lenders get a little exuberant and underwrite cash flow that didn't exist using market rents that had never been achieved. And that obviously created problems when the pro forma market rents were much higher than current market rents and never materialized. And I think real estate underwriters today really have the discipline. And there was sort of a transformation after the financial crisis when everyone started using debt yield. Debt yield was not a lender metric that was used that much. We looked at debt service coverage ratios and LTVs, but debt yield has been the key metric now for, 10 years. Or since around the financial crisis. And having in-place cash flow is really key, and seeing a path to it. So a borrower would need to, if it's a refi or acquisitions are easier because then the borrower is putting cash equity into the property. They would have to get a loan. Refis are a little more interesting, and can you get a cash out refi? Absolutely, if the cash flow justifies it. I don't see a reason why you can't fund out cash. Do you like doing that? You don't love it, but if you do see intrinsic equity value in the property, that is something that they would forfeit if they lost the property, assuming that value can be objectified by property sales at a similar basis in that market, comparable assets. But there is a lot of competition. I think it's very easy for a borrower to obtain a well-structured transitional loan today at very attractive spreads.
And is there an asset class today that is going to struggle in your investment committee?
It's also market specific.
Right. Market. Well, let's go market. Help me. Market or asset class?
Well, hotels in New York City have struggled for a while. There was just a tremendous amount of new supply, and you have seen no growth in RevPAR, ADR. Right. I mean, we've seen transitional loan requests for hotels that are doing 92% occupancy, but their debt yield is 3%. I mean, where does that go? You can't see your way to a debt yield that makes sense on that. So the borrower has to contribute more equity to those. But we've seen numerous examples of that in the city, particularly of unbranded hotels, boutique hotels. So I think hotels are challenging in New York. Frankly, regulated housing is challenging in New York right now. That's an example of one of these unforeseen risks. Even though we knew there would be a regulation change, we didn't know it would happen to the degree it did. But on June 14th, the New York State legislature changed the amount of rent landowners had on rent-regulated units. So on that day, the equity values of properties dropped anywhere from 15% to 40%, just because they couldn't push rents or increase rents to a level that they thought they could when they bought the properties. It's sort of like a government taking, in my view. And here in Chicago, we're not seeing that many financing requests right now because the sales activity has slowed down because of the tax regime here, of the property taxes. People are just afraid to buy properties, and sellers are still wanting values based on the old tax regime. So that's creating trouble. Retail for a lender has been challenging for quite some time. I think in most of the retail requests that a non-bank lender will see are frankly Class B malls or lower that are struggling from a cash flow, and the borrower needs to refinance, and those are very challenging.
Yeah, I mean, just to pick up on what Greta was saying and not leave her hanging as the only person giving opinions about this stuff. I agree. I think it's down to market, asset class, usually market and asset class together. I mean, Kathleen said this on the panel this morning. We try to invest where there's growth, and that could be a particular asset class in a market that's not exhibiting a lot of growth, or it could be most asset classes in a market that's disconnected from the rest of the world and experiencing outsized growth. That usually carries you through a lot. I mean, we've talked a little bit about pro forma underwriting. In a way, every underwriting is pro forma because you can't predict the future. So the best thing you can do to tilt the odds in your favor is to be in a place where you're seeing a lot of rental growth and hopefully not a huge amount of supply following that growth. And that's really the thing that can burn you over time. There's a lot of little unforeseen things like the rent regulation thing, like whatever's going on with co-working that could cause some excess vacancy that people wouldn't have necessarily predicted in some of these bigger office markets. But if you're investing with growth, you're going to see your way through a lot of these issues, especially when you're a lender and you're starting at 70 LTV.
Yeah, agreed. Tiffany, a view on this broad topic? Are there, again, market or asset classes that are more challenged in your investment committee?
Yeah, I think all the things that they've said, I would completely echo. The one thing that didn't come up is we see a lot of leasehold financing requests. So for us, we also focus a lot on the look-through value of the leasehold. And what I mean by that is, if someone's broken at some point in time the ground lease into a leasehold interest, they're looking for us to finance the improvements on the property. And we look at the value of the ground as if it's debt and say, okay, all in with that ground rent treated as debt, or that ground lease treated as debt, what do we think that leverage is? And if that leverage is over 70 or 75 LTV, what I otherwise would have lent on that property, then we're not going to lend on it, or we're going to reduce the leverage that we would do on the property. So that comes up a lot. We also won't lend if the same party's in the leasehold interest and in the ground. And I also do a lot of single tenant lending in the CMBS space. And so that is very, corporate parent dependent, a little bit different than a lot of the things that have come up thus far. But if you're lending on let's say someone's headquarters location, you're a lot more focused on how is that parent performing. And I think one of the great things about at least our business is that because we have the whole firm, I can leverage someone that's in that sector that can say, oh, you're going to finance this company's headquarters. This is our view on that company.
But by the way, I checked with our servicing team. We service about $500 billion of mortgages, both for our own balance sheet and for others. So it's a big book with a lot of data. I checked the other day, where are they seeing outsized delinquencies in what asset class and or geography? It was pretty interesting. So the asset classes that popped up were student housing. We're seeing an inordinate amount of delinquency in student housing, partly because of excess supply that got created. We're seeing increased delinquency in the suburban hotel market, and also outsized delinquency in single tenant office in secondary locations. No surprise, where the risk is very binary. So Tom, take us through sort of a number of risks that pop into the debt business, and sort of how do you think about the trend and or the response? Let me give you 4 that I came up with. One is interest rate uncertainty. By the way, you can tackle all, none, or one. Interest rate uncertainty.
I'm going to turn off my mic. You just do them all.
Real estate, interest rate uncertainty, the ever-present real estate cycle or economic downturn, the regulatory event or environment, which Greta just gave us a sneak peek into the implication in New York of the law around rent regulation. By the way, New York's not alone, so Oregon instituted a rent control ordinance. California, I think our governor's going to sign a bill here very shortly with some limitations in terms of rent increases. So the movement's picking up momentum. So regulatory environment, and then the 4th is obviously the deteriorating global economic conditions. So how do you all think about all of those, or are there other things we should add to the list?
We try to think about, everything that we can, right? It's like Donald Rumsfeld, who I normally don't quote, used to say,
Wow.
you know, right? What
Then no one
information
knows.
comes, what you know that you know, what you know that you don't know, what you don't know that you don't know.
Yeah.
So we try to
like that.
focus on what we know that we don't know, because those are the risks, and
Yeah.
the risks that we don't even know about, those are the real ones again, right?
Right.
So with interest rates, you know, it's a function of whether, first of all, it's balance sheet for us or whether it's going into a securitization. Because the easiest way, from the perspective of we, the bank, the lender, to manage interest rate risk for securitization is to shorten the length of time between origination and the actual securitization.
Right.
Right? So I don't know, Tiffany, but you know, what is it, 45 days, 60? I mean, between.
It's a SASB deal, we'll do it in under 10 days.
Yeah.
But if it's a conduit deal, you need to gather enough loans to do about
Right.
approximately $800 to $1 billion deal. That can take 45 days.
Yeah,
So
but
that's-
so you're taking
but it's-
45 days worth of interest rate risk.
Right.
And you can hedge that if you want, you
Right.
know. But our hedging tends, you know, but typically, we don't really hedge the conduit stuff. We hedge the balance sheet, longer dated
Right.
products. So, and that's how we deal with interest rate risk from that perspective. Then the other interest
And by the way, the loans that you intend to securitize, and probably a question for both you and Tiffany, if you had to own those loans, would you be happy owning them?
I think my answer is yes.
Uh-huh.
Okay, it's, you know, I don't think you can be responsible in today's environment with investor base that is more focused on quality than it ever was in the past. I don't think you can originate a loan that you're not willing to own. Because number one, you don't know if it might get kicked out of the deal because the BP buyer doesn't want it. So you gotta be ready, to own it. And I think the real art of the securitization is having the best insight you can as to what buyers are gonna want and not want, and how they're gonna price it, and what the documents they need have to look like, right? And almost by definition, that means you're gonna be okay owning that loan from a credit standpoint, because if you're not, you run the risk that you're not gonna get it done in the securitization.
Yeah.
The other thing I would say is a lot of times we're the sponsor for the deal, which means you can risk retain yourself. So a lot of times on these deals, we're actually holding part of the risk retention piece. So you are owning it for 10 plus years.
Yeah. And Tom, you'll hold risk retention on your balance
Well,
sheet?
we have to. Well, we don't have to. I
You
mean,
could sell it.
we have, you know, you can either hold a vertical strip,
Right.
which most banks find very unattractive because
Mm-hmm.
it gobbles up a lot of capital and jams your balance sheet. You're not getting the returns that you're, right? Or you can own the horizontal strip at the bottom of the stack.
Right.
Or if you do that, you also have the ability to sell it to a third party, as long as that third party conforms with
Right.
the constraints.
TPP requirements,
Right.
third-party
Right.
purchaser requirements.
Right.
But
Yeah.
you can also do, a lot of times what people do is they do what's called an L shape. So we hold, let's say, a small vertical sliver on our balance sheet. You sell the bottom. In a conduit, normally be a piece buyer. In a SASB securitization, it might be Blackstone, who knows? But in that case, the reason that you would do that in a conduit securitization is that in order to sell the bottom tranche of the conduit deal to a B piece buyer, when we did previously, think pre-risk retention, free-to-trade B pieces are sold at a discount. And so they traditionally had not bought enough of the deal to actually qualify for risk retention. So what does that mean? It meant that once you were selling them single Bs and double Bs, you were paying a premium, an illiquidity premium, to have them hold those. And so you've seen a lot of people go towards this L shape where you do an efficient B piece, but then you hold a small vertical strip.
Yeah, I mean, just from an investor perspective, obviously, the more optionality you have to buy and sell securities, the more confident you can be, making an investment. Especially in these 10-year fixed rate deals, things will change over time. Not every conduit deal works, but we do buy a lot of non-investment grade credit securities in conduit deals. And we have, really great technology that allows us to underwrite and store our underwriting. So next time we see the bond, or monthly when we want to do updates to our servicing reports, we can see how things have evolved. I would say as a general matter, the CMBS business has been fairly disciplined. Some of that's driven by the rating agencies, as someone on the panel referred to or alluded to earlier. But LTVs have been very modest. And so really, for us, it's just down to there are going to be certain asset classes or certain markets we don't love. Actually, probably in everything we buy, that's going to exist. It's just how do we control for as limited exposure as possible? Because there's 50 loans in a
to some
pool.
degree, the real interest rate risk is not whether you're hedging your rate, right? The real interest rate risk is what happens 7 years down the road if it's a balance sheet loan, right?
Yeah,
And
or a
rates have
conduit loan.
spiked,
Yeah.
Right.
and the residual
Refinance.
value gets nailed.
Yeah.
Now, I think the good news in that regard, and but by the way, the risk of that almost definitionally has gone up, given how low rates are today,
Yeah.
and given the fact, I just saw a report, the Green Street sort of commercial property index. Today's real estate is trading at a 30% premium to where it traded at the peak before the financial crisis.
Right.
Okay? And why is that? Because you have a 10-year at 1.7.
Right.
But we also have an average LTV today in the sort of mid-50s, 57, 56 conduit space versus 10 percentage points higher, right? 11 years ago. And we've got debt service coverage ratios of over 2 times versus probably 1.3 or something, right? So there's actually there's more capacity for rates to rise without the senior lender getting knocked off, but it's still troubling. And every deal you do, you have to you always end up stressing it at some higher interest rate down the road, okay, to see how, at maturity, what's the rent roll expiration schedule looking at the same time that you might have an interest rate spike, and how do you stress it?
Right.
Because we want to know what our realistic, every time we make a loan, we don't assume we have a 0% risk attached to it. We know we have risks attached to it. The question is, are they acceptable risks?
Right.
And have we done all we can to bracket them correctly?
Right.
Yeah, and this is where Greta's metric of debt yield really comes in,
Right.
because that sort of normalizes for any interest rate environment. It's the absolute amount of yield that the asset is producing at your basis. As a real estate investor, this is a pretty sublime time to invest if you think you're doing
Right.
smart things, right? Because the absolute amount of growth you can generate annually in something you buy well is in excess of your base rates in the market that you're investing in. So it's the real estate market generally is getting a lot of tailwind from where rates are. Cap rate spreads are still pretty wide pretty much everywhere in the world to base rates on a historic level. It's just that absolute base rate level, as Tom says, if we're in a 5% interest rate environment in 5 years, some of these deals won't work.
But one thing to add to that before we move on is just that if you thought about a 10-year fixed rate loan today, you're locking in a very low coupon. So if you were to look at doing a financing September of last year, the swap rate was approximately 150 basis points wider. Credit spreads have widened less than 50 basis points, so your all-in coupon is about 100 basis points inside of where it would have been a year ago.
And as a bond investor, you can just assume that loan's going to pay to maturity unless there's some embedded credit event in the deal, right? Even why there was a lot of press about CMBX 6 for a while in the middle of, probably 2 years ago is when it really heated up, and you don't hear as much about it today. Why? Because most of those mall loans that are in that vintage of CMBX that everybody was thinking this is how you short the malls, they haven't defaulted. Why? Because interest rates are super low and the assets are still cash flowing. The tenants haven't left yet. So these things will, they'll keep paying, and everyone's incentivized to continue to extend deals like that where you're in an uncertain valuation environment. So, you get a lot of these dynamics from the rate environment.
So I was asked to talk about the future of real estate finance, which, by the way, I don't know what that really means. And I'm not smart enough to think about the future, but you all are. So maybe help me if anybody wants to tackle the question. You all have access to lots of information on a daily basis. How are you harnessing that information to make better decisions? A. B, is there any, without sharing any trade secrets, are you leveraging fintech at all in your businesses, and if so, how?
You want me to start? I'll start. So on the fintech side of things, depends how broadly you define that. We, as I alluded to, in our securities business and even in our lending business as well, we do a lot up front when we acquire an asset to capture all the details about that asset and to maintain the credit underwriting statistics around that asset over time. And that's really to inform our ongoing asset management decisions around everything that we own. More broadly, the biggest information edge we have, obviously, is that we own something like $250 billion of real estate. And the firm, those of you who saw Kathleen speak this morning know this. I mean, the firm we as a group spend a lot of time, energy, effort. It's not just technology, it's manpower, just communicating to ourselves about real time what's going on in these different assets we own across all these different markets, and feeding that back to the investment teams. So that's really, for us, that's information capture. That's the most important thing. But we try to do it in everything that we do and stay on top of things, and technology is getting more and more helpful.
Mm-hmm.
Yeah, I think technology for real estate has a long way to go to be truly useful. I mean, we all talk about it. I think every panel talked about it today a lot. And I think particularly on the credit side, it comes down to individual judgments, frankly. I mean, you can use technology to help gather data, and we use, things that have been around for a while, but they're really helpful, like CoStar and informational sources like that gather data and put it in a format that's usable, so you can see where property's sold or where property's leased. But when it comes to lending, it could be something as simple as, is it on the right side of the street or right side of the highway or the 405? And is this a sponsor that has done right by lenders historically? Mm-hmm. And fintech's not going to help you with that. So it really comes down to sharing information that you've gathered in your own portfolio, as Jonathan alluded to, so that, because that type of information, you can put it in some software like Salesforce, and that can be useful, but it still requires human communication and input. And then to make the decisions about it requires, I think, an experienced investment team. There's no substitute for that. And that gets to something I alluded to earlier about you getting exuberant about the markets or perhaps the competitive pressure to make you try to see something that's not really there, like a potential market rent where there's never been an example of it for. And that's where discipline and being credit people and lenders throughout various cycles is, in my opinion, the most important thing in credit today.
To Greta's point, there is nothing less modern than like an investment committee meeting in one of our offices, right? It's a bunch of humans in formal dress with pens and pads and printed documents.
Formal dress at Blackstone.
Sitting around debating with actual voice language whether or not we should make an investment. And to Greta's point, I think it will take a lot to disintermediate that. It sounds naive to say because it's happened in every asset class, but there is so much judgment that goes into everything real estate related.
But there are other ways that technology, I just had a friend who had surgery. It was a complicated surgery. And 3 or 4 years ago, he was telling me, it was at Weill Cornell. He said there used to be a staff of about 10 people doing this between the nurses and the doctors.
Yeah.
He said, with this new technology, 2 doctors and 3 robotics.
Right.
And virtually all of the actual, the old thing about the surgeon's handshaking, that's gone, okay? But you still need the doctor's judgment, right?
Yeah.
And it looks like the inside of a space shuttle. He said it doesn't replace the doctor's judgment,
Right.
But in some ways it might create a better outcome.
Creates efficiencies.
It creates efficiencies, and we're testing right now in Hong Kong, not in commercial real estate, but in our consumer bank, automating credit underwriting for consumers. Right. And we're testing machine learning in Hong Kong also. I don't know why in Hong Kong. Maybe if stuff blows up, it's not as bad for us. But financial statement analysis. We're doing digital authoring of bilateral credit agreements now, right? And we're doing machine learning mining of legal documents. So that doesn't replace judgment, but if you can get the information, if you got the data,
a lot of efficiencies.
Yeah.
a lot of efficiencies, and Bitcoin's doing what it's going to do to the title insurance industry, and maybe tokenization will have some impact on ownership, liquidity. Who knows, right?
Who knows? Yeah. I think the way that we've used technology is far more on the CMBS side. I think transitional lending, what Greta and Jonathan was saying is like, it's so nuanced. You're making very specific market leasing assumptions, time frame assumptions, where are you located, who's the sponsor, what's their liquidity, and all of those credit decisions along the way, and how you feel about your basis relative to trades that have happened in the market and how comparable those trades are. On the CMBS side, not using it necessarily in underwriting because it's still similar credit decision making, using it more in bond pricing models, using it more in terms of knowing all the CMBS deals are public. So if I see another issuer has a deal, we go through, well, I don't go through, but we have strats go through all the loans that are done and map those to sponsors, whether we saw that loan, and if we saw it, what we bid and where it ended up. And so that feedback loop has been really important. If you didn't see a deal, it shows you people you're not adequately covering. If you did see the deal and you missed it, did they ultimately reprice the sponsor, or did you miss something in the underwriting along the way or the agency treatment along the way?
Well, I'm for all about expert judgment, which means that all of us should have jobs in the next 3 to 5 years, assuming we made good bets today. You
Honestly,
and I maybe
I think
not.
you and I have the shortest runway.
I think that's right. Tom. I'm glad you said that. So just a couple other questions that I want to get to some sort of running a business, some business questions. Is there anything any of you would see over the next 3 to 5 years that would suggest the industry, our finance industry, is going to look different? And anything out there that would suggest it might look different, and if so, how might that look? Obviously, Blackstone will be bigger.
I can start with, it's a nuanced answer, but
Right.
We spent a lot of time in the regional mall space. I specifically have spent a lot of my career in the regional mall space, and I think we can all agree that retail isn't in equilibrium. And we've done a lot in terms of trying to figure out the right structure around B malls, doing pooled deals where you're cross-collateralizing assets, doing dividend stoppers so you're amortizing down the loan and creating more cash flow in the system for CapEx. But on like a personal note, one thing that I've really seen is on the technology side, there's been a lot of growth in clothing rental programs. So the biggest one being Rent the Runway. They have 3 million members. They're the largest dry cleaner in the US. And they have membership programs that are $150 a month. They're targeting women in their 30s. And so it's kind of like the Netflix DVD back in the day where you'd have 3 items, you swap them in and out. If you want to keep it, you buy it at a discount because it's used. And so the people that I know that have done those programs justify it by saying, well, I looked at my dry cleaning costs before and afterwards, and I saved more than $150 on dry cleaning. So that's ignoring the fact that maybe you're buying fewer items that you wore once and things like that. And so what's interesting to me about this is it's kind of like a digital version of a department store. You're getting clothing from different retailers, you're getting jewelry, you're getting handbags, things like that, and ultimately sometimes buying them. So you could imagine a world in which, a Saks Fifth Avenue or a Bloomingdale's or someone like that ended up picking up some of this technology to tap into the next generation and people that are more accustomed to renting things.
But I think, we've talked about how technology has transformed many industries, Amazon, et cetera. We're still a people business, and real estate is still a physical asset. So I think WeWork's, not to bring them up again, but WeWork's tried to make themselves off as a technology company, but they were leasing physical space. They weren't really a real estate company because they didn't own it. But they were somewhere in between, but they were not a technology company. But so our business in the lending side, which requires judgment, requires us looking at the asset. I mean, I don't see how that will become how that can scale with the internet or with technology. It will become more efficient from data gathering, without a doubt, and I think that'll be useful.
But the changes that you asked about in
Right.
the next 3 to 5.
Right.
I mean, look, we know one change is
Right.
coming right down the pike.
Right,
And that is the GSEs are going to shrink,
right,
right? They're going to be a much less
Right.
important player
right.
in the overall capital raising, and it's going to hit multifamily, right? We know they haven't put out their definitive game plan, but we know they're going to be focused more on subsidized affordable housing. They're going to be reducing their multifamily focus to some degree. And That's going to allow the private sector and other entrants to come in. That's going to have an impact on pricing. It's going to have an impact on a lot of ways that the big users of that are going to do going forward. We know that. We also know that it's likely that they're going to put in place far more restricted EB-5 financing regimes. A lot of developers have used that. It's not been done yet. I mean, the Trump administration came out, right, in the summer and said they were behind it.
Yep.
But then a real estate developer in East Hampton threw a party, so maybe he won't be around. Okay? I don't know.
Yeah.
But that's going to have implications.
Yeah.
And then finally, what is the biggest real estate crisis we have in this country? It's affordable housing.
Yeah.
I'm glad
And-
you covered that.
You're going to cover that?
No, I'm glad you
Oh,
covered it because
because-
I would have covered it.
Yeah, but that could very
Right.
well change the real estate financing landscape.
Agreed.
And change how cities and communities,
Agreed.
right, decide to take a different zoning approach and so
Right.
forth.
Yeah.
Yeah.
And that's all going to fit into the real estate
And the
financing.
GSEs may play a role in that as well.
Yeah.
I mean, to your
Right.
point. So,
Right.
yeah. And we talked about the first order change, which is new rent regulation.
Right.
That's an obvious reaction to where rents have gone. It's unaffordable to live in a lot of these cities. There are, many sides to that issue. But the
Right.
thing that's not addressed is the supply issue that
Right.
Tom's talking about. And, there isn't enough money and capital in government anywhere to deal with the development of the supply that's required to meet the housing demand in these cities. And so something has to be done to bring private capital back into these markets.
Right. Yeah, and I think that'll be a fascinating opportunity for those of us in finance to help solve that.
We also know that SOFR is ultimately coming at the end of 2021.
Right. Yeah.
That's true.
Greta was kind enough to give us a tutorial on LIBOR, the LIBOR transition, but we might want to save that if we can. But that is a growing topic, and if you're not front and center, you need to be front and center with that transition. So let me, in the time remaining, let me switch gears if I can, maybe get some insight from each of you individually. So Tom, let's peek. By the way, I'm going to ask you to peek inside of all your toolboxes, but peek inside your toolbox. Help us, what are the ingredients of success for Tom Flexner within that toolbox? It'd be interesting to hear. Also, maybe running your business, what are some of the challenges, whether it's diversity, leadership? What are you doing there?
Well, look, I think first and foremost, okay, the one thing every organization that's successful shares is having great people that are motivated and aligned and that you can delegate to with some level of trust. And if you don't have that, it doesn't matter what the business model is, right? So I think as leaders, we have to create and sustain cultures that reward our people for holding the ethical values and the fiscal values that we have as an institution have. Diversity is really important for not just for commercial success, but because it's the right thing to do. And we are a bank. We're the most global bank. I mean, we're in 98 countries. I think inside our bank, every single language on the planet is spoken through multiple people. So we have diversity there. Okay, gender diversity is something that we constantly struggle to work on. But look, I think success. Blackstone is successful for also different reasons than we are. I mean, we have a business model which is unique today, anyway, on Wall Street, where both the lending side, the balance sheet side, and the investment banking side report up jointly. So it's a completely integrated model. And it helps us keep, because we do have balance sheet limitations like every bank does. We have to find out, we have to allocate it over those 99 countries too. So the more we can sort of align the balance sheet with our client priorities where we're also advising them and doing capital markets for them, the more powerful it becomes, the better the returns are. You know, Goldman does the same thing, although it's not organized that way, but it doesn't have to be as long as the coordination is there. We have a common P&L, okay, and Jonathan knows because we do a lot of work with him, like you do. There's never been a call since I've been there where an investment banker and a commercial mortgage lender get on the phone, or their bosses do, and say, well, how are we going to split it? There's no split.
Yeah.
Yeah.
The teamwork.
The basic ingredients are the same though.
Right.
Accountability, trust.
Right.
You know, two words I'd throw in there that are byproducts of those would be transparency and collaboration.
Right.
And you know, what helps us be successful is having, you know, people in roles where they're leading businesses and they have not only a willingness but a strong desire to communicate openly with each other about what they're seeing, where is their value, and these ideas build on each other, and that's how you find the next thing that's a little bit different from what everybody else is looking for. And that culture has to live up and down the organization. I mean, one of the secrets of success of Blackstone is the more senior you are, the harder you work. I mean, Steve never takes a minute off. John never takes a minute off. They're always available. They review every deal. You know, and that puts you on notice that that's how you're expected to be as well. And that level of accountability, you know, is something that you know, again, comes from culture. It's the most important thing.
Greta, you've had a super successful career. What do you attribute some of those successful moments to?
Well, I think I've learned more in the last few years as I became a CEO. I was had worked in environments where there was a dominant personality at the top, and I've learned that creates an environment where people quit innovating and thinking if they're not empowered. So since I've been at TPG, I've read a lot of these books, Team of Teams. I mean, I think what you all are espousing is exactly what General McChrystal talked about in Team of Teams, of empowering people, delegating. But you have to trust but verify. In Team of Teams, they were delegating life and death decisions to people on the streets of Baghdad. So you have to trust them. You know, you really have to trust them. And I remember I was speaking to General McChrystal a few years back, and I said, how do you know you can trust someone with machine gun? I'm trusting someone with getting the interest rate right? You know, it's not really a life and death decision. And he goes that just comes from working with them and open communication. So I really believe that's the most important thing, and in empowering your people, listening to your people, and having a shared mission, purpose, and goal, and you know, happy employees really creates better results for the shareholders, for everyone.
Agree 100%.
Yeah, that's a great book, by the way, Team of Teams, General McChrystal, where he was able to bring in Iraq the, 3 or 4 branches of the military service together to share information, to focus on getting the bad guy, whoever that bad guy was at that moment.
Yeah, previously, the guy on the street would say, I need a drone to get this building at this location. It would go to his boss, and then to his boss, eventually it'd get to the Pentagon, and by the time the decision was made, it was too late. So they were empowering the person on the street to make that decision.
Just one more thing that Greta said that I think doesn't get enough airtime in a conversation like this is just that positive environment as well. People need to really enjoy their work environment to bring their best every day. I think it's super important.
Tiffany, anything to add?
The one thing I would add is just mentorship and having the right sponsorship is really important too. And sometimes that comes more naturally if you're on a smaller team, but our team's called 100 people, so trying to make sure people are matched up in a way that they feel like they have someone they can really go to with questions or guidance on their career and things like that.
All right, we're at the 5-minute mark, so I'm going to stop and open it up to Q&A if I can. Anything, any questions? Yes, sir.
I'm curious for some national perspective on Chicago as a place to invest. What you like, what you don't like.
Well, I could say that if I look at our portfolio and our assets, our multifamily in the outskirts of Chicago is performing very well. Our hotel loans are underperforming. But they're underperforming their business plan. They're not non-performing loans. They're just underperforming their business plans. If there's any present here, we have no non-performing loans. But so yeah, the hotels here are very challenged. But yesterday I spent some time with various mortgage brokers and owners of real estate in Chicago, and they on their mind was the the tax regime here, the property tax regime, and how it's stifling investment activity and decision making.
Yeah, yes.
The discussion internationally about negative interest rates, how will that impact the lending, interest rates in the future? What's your expectations?
I just read an interesting fact, and that is that when interest rates peaked in October of 18, at least here in the U.S., 11% of the world's interest rates were negative. Today, it's now 30%. That's the U.S.'s dropping rates, and then obviously the EU and others. And I tell you, it's a real concern for us that are LIBOR-based lenders. So what we try to do, and I'm not just talking about negative interest rates, I'm just talking about interest rates going down further, LIBOR in specific, is we try to put LIBOR floors embedded in our loans. Insurance companies have had minimum interest rates for decades, and I think that our entire industry needs to really incorporate more floors, if y'all are hearing me.
Yeah. I mean, I think it's a question just more broadly for all investment products or real estate more broadly of just what are the appropriate return expectations in an interest rate environment like this, and how long are we going to be in an interest rate environment like this, which is anybody's guess. I think more people today will tell you lower for longer is their default assumption, which over time will cause people to reduce their return requirements on their capital deployment. We try to put floors in deals and things like that to keep a minimum a return in the deal as LIBOR moves around, but it's a challenge. You even have in Denmark right now, they have a negative residential mortgage product. So I don't know how that works. You get paid by the bank.
Well, look, there's $12 trillion of global debt that has negative interest rates.
15.
Has it gone to 15? And it's an unnatural phenomenon, and frankly not sustainable, where you have to pay someone to keep your money, basically, right?
Yep.
And it's the ultimate risk-off trade, right? It's largely in Europe, not entirely, with sovereigns over there, and you can only think that if it continues, it's because the world is saying we're going to have deflation, not inflation, and I'm better off paying you 50 basis points a year to hold my cash than I am to invest it somewhere else and lose 20% a year.
Yep.
Yeah.
I mean, it's really on its head, and it's not sustainable.
One last question. Anybody? Okay, great. Well, I want to do two things. I want to thank DLA Piper for hosting a terrific session today. And I also want to thank my esteemed colleagues who I think did an admirable job of giving you some insight into the business, the landscape, and how they think about risk in the finance business going forward. So thank you very much for your preparation.
Thank you, Mark.
Thank you, Mark.
Thanks.